Let's talk about selling your business, something that when done right can change your life, your family's life, and generations to come. Truth is, until you sell your business, you're not reaping the full reward for all of those sleepless nights, tough decisions, and risks that you've taken on. I've had the privilege of guiding business owners from startup through to exit, and in this video, I'm going to share with you some of the strategies and ways you might choose to structure your exit. My name's Rayhan Mobile. I'm a chartered accountant and the founder of Psychic Accounting. Now, the right exit strategy combines three things: preparation, timing, and tax planning. But before you consider that, let's start with the different ways you can sell your business. Each one has its own advantages and disadvantages, and understanding your options is the first step towards deciding how you structure your business and how you eventually want to exit it. First up, we have asset sales. This is where the buyer will purchase certain elements of your business, for example, some IP, a client list, equipment, instead of buying the company as a whole. Asset sales are brilliant if the buyer only wants a specific part of the business you built. They're really common in sectors like retail, hospitality, and manufacturing because the business value is heavily driven by the value of physical assets. However, even for a business like an agency that is very digital in nature, asset sales can be a great way to sell a part of your business, especially where you spend time and money developing software or other intellectual property that someone values. The key advantage here is flexibility. You can choose which parts of your business you want to sell and when. From a buyer's perspective, they have flexibility in picking and choosing what element of your business they want, and you can also have multiple buyers buying different parts of the business. There's a couple of important tax considerations here when it comes to selling assets. Firstly, the profits from the sale of those assets will be subject to capital gains. And secondly, you may need to charge VAT on certain items that you sell. Now, if it's the business selling the assets rather than you personally, instead of capital gains, there'll be a corporation tax consideration. Next up, we have share sales. This is what most business owners typically think of when they're thinking about an exit. In a share sale, the buyer is essentially buying the entire company, all of its assets, liabilities, and obligations. You're essentially handing over the keys to everything. For a seller, this is often preferred because you're not left dealing with any overhanging items from the business. It's a clean exit. Now, the next option when it comes to selling your business is a management buyout. This is where your management team will purchase shares from you and take ownership of the company. This is fantastic if you've built a strong leadership team that want to drive the business forward. Alternatively, you could have a management buy-in, which is where you have external managers buy into the company and take over and run it. These options can be particularly tax efficient when structured correctly. You may qualify for business asset disposal relief, and buyers will often leverage group structures to optimize their tax position. And the final option I'll talk through here is mergers and acquisitions. In an acquisition, one business will buy another business, usually through a share sale or an asset sale. The tax situation here can vary widely depending on how the sale is structured, but typically capital gains tax will apply. However, if structured using reliefs such as share for share, that gains tax may be deferred. Now, understanding these options is just the first step. Let's go a little bit deeper into the tax implication. Now, this is where so many business owners either win big or leave a ton of money on the table. Getting your tax strategy right isn't a small detail. It can save you 7 figures in the event of an exit. The big one is capital gains tax. When you sell your business, the difference between what you paid for it or the original value versus what you sell it for is taxable. Capital gains tax rates are currently 18% for basic rate taxpayers and 24% for higher rate taxpayers. But there are still legitimate ways you can reduce your capital gains liability. The biggest one is business asset disposal relief, which was briefly mentioned before, also known previously as entrepreneurs relief. Between April 2025 and April 2026, business asset disposal relief will reduce your capital gains rate down to 14%. After April 2026, it will reduce it down to 18%. These rates will apply to the first £1 million of lifetime gains. That means if you exited a business a few years back for £500,000 and claimed business asset disposal relief, you have £500,000 left for future gains. To qualify, you generally need to have owned 5% of the shares of the business and been an employee or a director for at least 2 years prior to the sale. Finally, when it comes to capital gains, you also have the option of deferred consideration. Now, it's quite a complicated area and you should seek professional advice. However, what this would do is defer when you pay the capital gains tax in the future. Doing this might keep you in a lower tax bracket if you spread it over a number of tax years, which will save you significant. After capital gains, the other two taxes you need to consider are VAT and stamp duty. It's worth remembering that VAT may apply to some asset sales, but not to a sale of shares. On the flip side, while there's no VAT consideration for a share sale, there is a stamp duty consideration. Now, while stamp duty is paid by the buyer, as a seller, you need to be aware of it because it may factor into negotiations. The key takeaway here is how you structure your deal will significantly impact the taxes that you pay. If you're thinking of exiting in the future, the planning starts years in advance. Make sure that you're working with an accountant or an advisor who's been through the process and can help advise you to A, maximize the value of your business, and B, to exit tax efficiently. If you're looking for an accountant and advisor who can help you eventually sell your business tax efficiently, book a call with the team at Sidekick using the link in the description. Thanks for watching, and I'll see you in the next one.